In every recession of the last 100 years, there was one thing you could always count on. When the economy crashed, the government could ride to the rescue. Interest rates got slashed, money got printed, bailouts went out the door, and eventually the system found its footing again. But right now, some of the most respected voices in finance are saying that playbook might not work this time. Not because the next recession will be bigger, not because it will be scarier on the surface, but because the tools we've relied on for a century may not have the same power they used to. And if that's true, the people who are prepared for a normal downturn could be caught completely off guard by what's actually coming. So what exactly is different this time? Stick with me, because by the end of this video, you're going to understand exactly what these experts are watching, why it matters to your paycheck, your savings, and your future, and what history teaches us about how ordinary people protect themselves when the usual rules stop applying. Right now, in living rooms and boardrooms across America, there's a quiet unease. You can feel it in the headlines. You can feel it in the way people talk about their 401k, their mortgage, their job security. Inflation hit levels most Americans hadn't seen since the early 1980s. The Federal Reserve raised interest rates faster than at almost any point in modern history. Debt, both government and personal, has climbed to levels that would have seemed unthinkable a generation ago. This isn't a video meant to scare you. It's a video meant to inform you the way a documentary should. We're going to walk through exactly why economists and analysts are drawing a distinction between this potential downturn and the ones that came before it. We'll look at the tools that pulled America out of past recessions, why some of those tools are running low on fuel, and what that could mean for how this next chapter plays out. And we'll look at how everyday people throughout history have used real, tangible assets like gold and silver to protect their wealth when paper promises started to wobble. This matters right now because the decisions you make in the calm before a storm are almost always more powerful than the decisions you're forced to make once it hits. So let's start at the beginning with a simple question. What actually causes a recession, and why do some hit so much harder than others? A recession, in the simplest terms, is what happens when an economy stops growing and starts shrinking. Businesses sell less. Companies lay off workers. People spend less because they're worried or because they simply have less to spend. It's a cycle, and it feeds itself. Throughout American history, recessions have come in waves. The economy expands, sometimes for years. Prices rise, businesses take on debt, confidence builds, and then something breaks the momentum. It might be a stock market crash, a banking crisis, or a shock like a war or a pandemic. Since the end of World War II, the United States has gone through more than a dozen recessions. Most of them lasted less than a year. A few, like the one in the early 2020s and the one in 2008, were sharper and more painful. Here's the part that matters for this story. Every single one of those recessions had an exit ramp. The Federal Reserve could cut interest rates to make borrowing cheaper, which encouraged spending and investment. The government could send out stimulus checks or increase spending on infrastructure and programs. Banks could be propped up so the financial system didn't collapse entirely. Those tools worked because, generally speaking, the starting conditions allowed for them. Interest rates had room to fall. The government's debt load, while significant, wasn't so large that new borrowing became dangerous in itself. Inflation was usually low enough that printing more money or cutting rates didn't immediately backfire. Now here's the question worth sitting with. What happens when a recession hits and those starting conditions simply aren't there anymore? That's exactly the concern a growing number of economists are raising. And it's the thread we're going to pull on for the rest of this video. Let's talk about interest rates first, because this is where a lot of the concern begins. When the Federal Reserve wants to fight a recession, its go-to move is cutting interest rates. Lower rates make it cheaper for businesses to borrow and expand, cheaper for people to get a mortgage or a car loan, and generally encourage spending instead of saving. It's one of the most powerful economic levers in existence. But here's the catch. You can only cut rates so far. During the 2008 financial crisis, the Fed slashed rates all the way down to near zero. During the pandemic in 2020, it did the same thing again. When rates are already sitting near zero, there's very little room left to cut them further if a new crisis hits. It's like trying to brake a car that's already stopped. In the years following the pandemic, the Fed raised rates aggressively to fight inflation, which actually rebuilt some of that room. But that fight came with a cost. Higher rates mean higher borrowing costs for the government itself, for businesses carrying debt, and for households with credit cards, mortgages, and auto loans. So even though there's technically more room to cut rates than there was in 2020, doing so isn't as simple or as risk-free as it once was, because inflation could reignite if rates come down too fast. Now let's talk about government spending, because this is where the story gets even more complicated. In past recessions, the federal government could step in with stimulus spending because its overall debt, relative to the size of the economy, was manageable. That's changed. The United States national debt has climbed past levels many economists once considered a hard ceiling. Interest payments on that debt alone now consume a massive and growing share of the federal budget. When a government is already spending an enormous amount just to service its existing debt, its ability to comfortably take on new debt to fight a recession becomes more constrained. This is the heart of what experts mean when they say this recession could be different. It's not that a downturn itself would necessarily be more severe on day one. It's that the traditional rescue tools, cutting rates and ramping up spending, may not have the same room to maneuver that they did in 2008 or 2020. And if the usual medicine is in shorter supply, the recovery could look very different from what most Americans have experienced in their lifetimes. So if the old playbook is compromised, what actually happens next? To understand that, we need to look at a period in American history that many economists say offers the closest parallel, and it's a period most people alive today never lived through. To understand what a different kind of recession can look like, we have to go back to the 1970s. For decades before that, Americans had grown used to a certain rhythm. When the economy slowed down, prices would usually ease up too, because weaker demand meant businesses had less pricing power. But in the 1970s, something strange happened. The economy slowed down, unemployment rose, and yet prices kept climbing anyway. Economists coined a new term for it, stagflation, a combination of stagnant growth and high inflation happening at the same time. This broke the assumptions a lot of policymakers had relied on. The usual fix for a weak economy was to loosen monetary policy and spend more, but that risked making inflation even worse. The usual fix for high inflation was to tighten monetary policy, but that risked making unemployment even worse. The country was stuck between two bad options, and everyday Americans felt it directly. Gas lines stretched around city blocks. Grocery prices climbed month after month. Savings accounts that once felt safe were quietly losing purchasing power every single year. It took a dramatic and painful set of interest rate hikes under Federal Reserve Chairman Paul Volcker in the early 1980s to finally break the back of inflation. But it came at the cost of a sharp recession and high unemployment before things stabilized. Why does this matter today? Because many economists point to today's combination of high government debt, a Federal Reserve trying to balance inflation against growth, and a global economy facing new pressures, as conditions that echo, in some ways, that same difficult balancing act. To be clear, this is analysis and comparison, not a guarantee that history will repeat itself exactly. Every economic era has its own unique variables, but the lesson from the 1970s is one worth remembering. When inflation and economic weakness show up together, the usual playbook stops being simple, and ordinary people end up needing to protect their own wealth rather than relying entirely on the system to protect it for them. And that brings us to a pattern that has shown up again and again throughout history, in the 1970s and long before it. When paper currency starts losing trust, people turn to something older. Gold and silver have played a role in human economies for thousands of years, long before modern banking, long before central banks, long before the dollar existed at all. And there's a simple reason for that. Unlike a currency, which is essentially a promise backed by a government, gold and silver are physical assets. Nobody can print more of them on demand. Their value doesn't depend on the financial health of any single country. During the 1970s stagflation era, gold went through one of the most dramatic price increases in its modern history, as investors looked for a place to protect their wealth, while inflation ate away at the value of cash. This is a well-documented historical fact, though it's important to note that past performance in one era doesn't guarantee identical performance in another. The reasoning behind why investors turn to gold and silver during uncertain times isn't complicated. When people lose confidence that a currency will hold its value, or when interest rates on savings accounts fail to keep pace with inflation, money naturally looks for somewhere else to go. Real estate is one option, but it's illiquid and expensive to buy and sell quickly. Stocks can offer growth, but they're also tied directly to the health of the economy that might be struggling. Precious metals occupy a different category entirely. They're not a bet on a company's earnings or a government's promises. They're simply a tangible store of value that has held meaning across nearly every civilization in recorded history. Central banks themselves seem to understand this. In recent years, central banks around the world, including in countries looking to diversify away from heavy reliance on the US dollar, have been purchasing gold at a pace not seen in decades. When the institutions that manage entire national economies are quietly stockpiling gold, it sends a signal worth paying attention to, even if they never say so directly in a press conference. None of this means precious metals are risk-free or guaranteed to rise in value. Like any asset, prices can be volatile in the short term, and they don't pay dividends or interest the way stocks and bonds can. This is analysis of a historical pattern, not financial advice or a promise of future returns. But understanding why gold and silver have played this role for thousands of years helps explain why so many financial experts keep bringing them up in conversations about a recession that could behave differently from what most Americans are used to. Let's bring this all together because there are a few threads happening at once, and it's worth being precise about what's fact, what's analysis, and what's genuinely uncertain. It's a fact that the national debt has grown to historic levels relative to the size of the economy. It's a fact that interest payments on that debt now consume a significant and growing share of federal spending. It's a fact that inflation surged to multi-decade highs in the early 2020s, and that the Federal Reserve responded with one of the fastest rate hiking cycles in its history. What's analysis, not fact, is the conclusion that these conditions mean the next recession will be harder to manage than past ones. That's the view of a growing number of economists, but it's not a certainty. Economies are complex systems, and predicting exactly how they'll behave is notoriously difficult, even for the experts who study them for a living. Anyone who tells you they know exactly what will happen and when is offering a guess dressed up as a fact. What we can say with confidence is this: the tools that got America through 2008 and 2020, aggressive rate cuts and massive government spending, have less room to operate than they did before. That's a structural reality, not a prediction about the future. And when the usual tools have less room to work, the path out of a downturn tends to take longer, feel more painful, or require different solutions than what Americans have experienced in living memory. This is exactly why so many financial experts are urging people to think differently about how they prepare. Not in a panicked way, in a deliberate, informed way. Diversifying savings, reducing high-interest debt where possible, understanding how inflation actually erodes the value of money sitting idle in a low-interest account. And for many, allocating a portion of their wealth into assets like gold and silver that have a track record, stretching back centuries, of holding value when paper currencies come under pressure. Here's what's easy to miss in the middle of headlines and debates. Recessions are not new. Economic uncertainty is not new. Human beings have been navigating booms and busts for as long as organized economies have existed. What changes from era to era isn't the existence of hard times. It's the specific shape they take and the specific tools available to manage them. The generation that lived through the Great Depression learned the hard way what happens when banks fail and there's no safety net underneath them. That experience led directly to reforms like deposit insurance that protect savers today. The generation that lived through the 1970s learned what happens when inflation runs unchecked. And that experience shaped decades of monetary policy afterward. Every hard chapter in economic history has taught the next generation something. And the lesson available to us right now is this: when the usual tools for fighting a downturn are constrained, individuals who understand that reality and prepare accordingly tend to come out the other side in far better shape than those who assume the future will look exactly like the past. So let's bring it back to where we started. Why are experts warning that this recession could be different? Because the traditional tools used to fight economic downturns, low interest rates and heavy government spending, have less room to operate than they did in the past due to already elevated debt levels and a higher starting interest rate environment shaped by the recent inflation fight. Because history, specifically the stagflation era of the 1970s, shows what happens when inflation and economic weakness collide at the same time, and how disorienting that combination can be for policymakers and everyday families alike. And because throughout history, when confidence in paper currency wavers, people have consistently turned to tangible stores of value like gold and silver to protect what they've worked hard to build. None of this is a guarantee of what tomorrow holds. Nobody, no matter how many letters they have after their name, can predict the economy with certainty. But understanding the mechanics behind these warnings, rather than just reacting to headlines, is what separates informed preparation from panic. The people who tend to do best through difficult economic chapters aren't the ones who guessed the future correctly. They're the ones who understood the risks clearly enough to build a little more resilience into their financial lives before they needed it. If there's one thing worth remembering from everything we just covered, it's this: the economy doesn't wait for anyone to feel ready. The best time to understand your options is always before you need them, not after.